Ever wondered how legends made their billions, while others hit a peak and then plummeted into oblivion? It's not just about striking gold, it's about the art, the science, the secret sauce of investing. The path to wealth isn't always a sprint. For many, it's a marathon. Warren Buffett, the Oracle of Omaha, didn't become one of the world's wealthiest individuals overnight. Instead, he embraced a slow and steady approach, diligently reinvesting his profits and letting the magic of compound interest take its course. This contrasts sharply with the story of Jay Walker, who saw his fortunes rapidly rise during the dot-com bubble, only to witness them plummet just as quickly. Walker's tale serves as a poignant reminder that seeking short-term gains without a stable foundation can lead to swift downfalls. Building wealth is not just about accumulating money, it's about making informed decisions and make that money work for you. By understanding the principles of investment and applying them consistently, you can pave your way to financial freedom. In this video, we're going on a journey, unveiling the tapestry of wealth building and unearthing the principles of turning a modest $1,000 into an investment treasure trove. Stick around, because by the end, you'll have the roadmap not just to wealth, but to wisdom in navigating the intricate financial markets. The basics of investment. At its core, investing is the act of allocating resources, typically money, with the expectation of generating an income or profit in the future. Think of it like planting a tree. You sow a seed, your capital, in fertile soil, an investment avenue, and nurture it. Over time, that tree grows and bears fruit, or returns. Consider a real estate scenario. You buy a property today, and as the area develops and becomes more desirable, the value of your property increases. By the time you decide to sell, you've earned a significant profit on top of what you initially paid. Investing allows your money to generate more money, setting you on the path to wealth creation. Beyond real estate and stocks, there are various avenues where you can invest, each with its own risk and reward profile. It's essential to diversify, spreading your investments across different assets to cushion against unforeseen market downturns. This approach, called diversification, can help you weather the highs and lows of the market, ensuring that a poor-performing investment doesn't drastically affect your entire portfolio. Over time, balancing your portfolio and understanding asset allocation can significantly improve your investment outcomes and mitigate risks. Initial investment options for $1,000. One might wonder if $1,000 is a sufficient amount to start investing. The reality is, while there are challenges with investing smaller sums, it's not impossible. One straightforward option is depositing this sum in a savings account. When you do this, you are essentially lending your money to the bank. The bank then uses your money to give out loans to other customers and charges them interest. The interest you earn on your savings is a part of this interest the bank collects. However, due to various economic factors, interest rates on savings accounts are relatively low nowadays. Despite this, a savings account can be a safe start to familiarize oneself with the financial world. Apart from savings accounts, another beginner-friendly option to consider is certificates of deposit, or CDs. Offered by banks and credit unions, CDs are time-bound deposits with a fixed interest rate that's typically higher than regular savings accounts. When you invest in a CD, you agree to lock away your money for a predetermined period. In return, you're guaranteed a specific interest at the end of the term. It's a relatively low-risk option, but it does require patience as you won't have immediate access to your money without incurring penalties. Understanding government bonds. A government bond is a debt security issued by a government to support its spending and obligations. It's similar to lending your money to the government. In return, they promise to pay you interest at predetermined intervals and to return the principal amount at the bond's maturity. The safety of government bonds, especially those issued by stable governments, is often touted as one of their main attractions. However, there's an inverse relationship between interest rates and bond prices. When interest rates rise, bond prices fall, and vice versa. This relationship can impact the return you get from your bond, especially if you sell before maturity. There are various types of government bonds, each tailored to different investment needs and horizons. For example, Treasury bills, or T-bills, have shorter maturities, typically up to 1 year, and are considered among the safest investments. On the other hand, Treasury bonds have longer maturities, going up to 30 years. While they offer higher interest rates compared to T-bills, They also come with increased sensitivity to market interest rate fluctuations. Before investing, it's vital to evaluate which type of bond aligns best with your financial goals and risk tolerance. Delving into the stock market. Stock markets offer tantalizing prospects. Who hasn't heard of success stories revolving around stocks like Amazon, Google, or Tesla? Investing in stocks means buying a share of ownership in a company. If the company does well, so does your investment. However, the stock market is volatile and comes with inherent risks. Established companies like Apple tend to be less risky than newer, more volatile companies such as Tesla. While the potential for high returns can be alluring, it's crucial to understand that with high potential rewards come high risks. It's essential to do thorough research and possibly consult with financial advisors before delving deep into stock investments. Another aspect to consider when exploring the stock market is dividend-yielding stocks. These are shares in companies that return a portion of their profits to shareholders in the form of dividends. While growth stocks like Tesla or Amazon offer the potential for significant price appreciation, dividend stocks, especially those from established companies, provide a steady income stream. For individuals looking for both capital appreciation and income, a mix of growth and dividend stocks might be an ideal solution. Introduction to index funds. An index fund is a type of mutual fund that mimics the portfolio of an index, such as the S&P 500. This index, for instance, comprises 500 of the largest U.S. publicly traded companies. Historically, the S&P 500 has delivered stable returns, making it a popular choice for many investors. If you're looking to get started with index funds, some top recommendations include VOO, or Vanguard S&P 500 ETF, QQQ, or Invesco QQQ ETF representing the NASDAQ 100 index, and the Fidelity Zero Total Market Index Fund. Investing in these funds allows diversification, as you're effectively spreading your investment across numerous companies. While index funds track specific market indices, actively managed funds involve a fund manager making decisions about which stocks or bonds to buy or sell within the fund. Research indicates that over extended periods, most actively managed funds don't outperform their benchmark indices, especially after accounting for higher fees. This is one of the reasons index funds, with their low expense ratios and broad market exposure, have gained immense popularity among investors. They offer a passive investment approach, meaning you're essentially betting on the entire market or segment rather than individual stock picks. Practical steps to start investing. The evolution of technology has democratized access to financial markets. Gone are the days when you needed a traditional stockbroker to place trades on your behalf. Today, apps like Robinhood and Webull have simplified the process, enabling users to buy and sell stocks with a few taps on their phones. If you're new to investing, starting with such apps can be beneficial. Not only do they offer a user-friendly interface, but they also provide educational resources to help beginners understand the intricacies of the financial markets. And as a cherry on top, platforms like Webull often have promotional offers, such as receiving 2 free stocks when you sign up using an affiliate link. While technology has made investing more accessible, it's crucial to approach it with a learning mindset. Before diving into any investment, take time to educate yourself. Many brokerage apps offer paper trading features, allowing you to practice trading with virtual money. This can be an invaluable tool to understand market dynamics without any financial risk. Furthermore, regularly engaging with financial news, joining investment forums, and even considering online courses can fortify your knowledge and confidence in your investment decisions. As we wrap up this guide on how to invest your first $1,000, it's essential to remember that investing isn't about immediate gratification. Instead, it's about planting seeds for a prosperous future. By starting early, staying informed, and making consistent, educated decisions, you can harness the power of compound interest and grow your wealth exponentially over time. So take that first step. Dive into the world of investing, continually educate yourself, and let your money work for you. Your future self will undoubtedly thank you.